Welcome back to the Wall Street Podcast. This deep dive extracts immediate implications from key market and regulatory signals. We're looking at the Wall Street Journal from Monday, September 22nd, 2025. We're focused on the crucial intelligence, the stuff that really determines capital deployment and valuation risk.
And we have to start with just the sheer scale of cash sitting on the sidelines. It's remarkable. Crane data confirms money market fund assets hit a record $7.7 trillion.
$7.7 trillion.
Yeah, and get this, over $60 billion flowed in just during the first 4 days of September.
Okay, so $7.7 trillion. That's huge. What's the real insight here? Why are investors so reluctant? Why aren't they moving that wall of cash back into risk assets, especially, after the recent Fed rate cuts?
Well, the takeaway isn't just the number itself, it's what it signifies. It suggests institutional investors, wealthy individuals too, they're essentially betting against the Fed's power to quickly stabilize things. Or maybe they just see better entry points ahead.
So they're holding cash like a cushion, waiting.
Exactly. Waiting for deeper discounts. You see strategists like at Société Générale recommending lower cash allocations, maybe down to 5%. But the actual holders of capital, they're cautious. The reporting mentions a 32-year-old actuary, for instance, waiting for a market correction, wants something more reasonable.
Right. A conviction that there's maybe more pain needed before it's time to buy.
That seems to be the sentiment.
Okay, so macro caution is locking up capital. Let's pivot. Volatility in human capital regulation. The Trump administration announced this new H-1B visa fee, $100,000 per application.
A one-time fee, yes. But the initial announcement, it plunged firms into, chaos over the weekend.
Chaos.
Major tech players, I think Amazon, Google, they feared this huge fee might apply retroactively or to existing visa holders.
Ah, okay.
So HR staff were scrambling globally, calling employees on leave, telling them to return immediately, just total confusion.
Until the White House clarified.
Right. They clarified it's one time, only for new visas, not renewals, not current holders. That calmed the immediate panic.
But wait, $100,000. Even as a one-time fee for new hires, that's a massive number. Is this just short-term noise? Or could it be a structural shift?
That's the big question, isn't it?
Does it push firms to just move development offshore instead of dealing with this cost, this volatility?
That is absolutely the structural risk. Even clarified, that fee size, it exponentially raises the cost of bringing in specialized foreign talent. It creates uncertainty, not just for hiring this year, but for multi-year budgets, strategic planning. It could definitely alter where high-value jobs are created long-term.
Okay, let's switch gears again. Regulatory guardrails, private markets. The SEC's Investor Advisory Committee approved recommendations. They want to expand retail access to private funds, private equity, hedge funds.
Yes, and this is a critical shift in thinking.
How are they planning to manage the risk that comes with that?
The key change is moving the suitability criteria. Less focus on just strict wealth requirements, more on investor sophistication.
Sophistication. How do you measure that?
Well, that's the challenge. But it potentially opens the door for a lot more capital to flow in. The guardrails, though, are crucial. The recommendations emphasize much, much better disclosure on valuation methods, complexity, and especially illiquidity.
So if the SEC lowers the fence around these private funds, you, the listener, the knowledgeable investor, you need to consider the implications. Being potentially mixed in with less savvy buyers, people who might panic sell illiquid assets in a downturn.
Precisely. Access is the goal, but the risk of mixing different levels of sophistication is real. Strict disclosure is meant to mitigate that, prevent systemic surprises. We'll see how effective it is.
Right. Turning now to corporate finance. We see this interesting split signal. On one hand, a clear M&A rebound. The Union Pacific acquisition of Norfolk Southern, huge deal, $71.5 billion.
And a massive payday for Bank of America advising the seller. Estimated $130 million fee, near record disclosed fee.
And global M&A volumes are up 30% year to date. So Wall Street's feeling pretty good deal-wise.
But contrast that sharply with what some are calling the cardboard slump.
The cardboard slump.
Yeah. Weakening demand for corrugated boxes. The stuff that packages, almost everything. E-commerce goods, construction materials, you name it.
And that signals
a pretty serious warning, potentially, about the health of the American consumer. International Paper is now forecasting a 2% decline in demand this year.
Why is cardboard such a powerful indicator compared to other metrics?
It's very direct, very analog almost. It's not a financial metric derived from market sentiment. Cardboard use ties directly to two core things. E-commerce packaging, which reflects consumer spending,
Okay.
And the housing market, which seems to be sputtering, affects moving boxes, packaging for building materials.
So this decline isn't just some boardroom statistic.
No, it's tangible. It reflects potentially reduced economic activity hitting Main Street, hitting kitchen tables, fewer bids being shipped, fewer homes being built or moved into. It reflects that corporate uncertainty we talked about earlier, filtering down.
So we have this tension. Record M&A fees, bankers celebrating, record cash still on the sidelines, regulatory uncertainty, and weakening consumer demand signaled by, of all things, cardboard boxes.
Exactly. And the essential task for you, the investor, is discerning what this all means together. Is this divergence, this mix of strong finance signals and weak real economy signals, plus the regulatory jolts, is it just short-term noise the Fed can eventually smooth over? Or are these actually the signs of deeper structural shifts? Shifts that will define how capital gets deployed, how assets are valued, and how regulations shape markets for the next decade. That's the necessary deep dive right now.